So, the very first question which comes to my mind, and investors generally ask this question, that what suddenly happened to the IT story? We did not see very high valuations in some of the well-known IT companies. The valuations, obviously, if compared to the last 3 years or 3-4 years ago valuations, they were high. But given that interest rates were also low, and we were in the in a scenario like COVID, where IT was considered to be a sector which was booming. And I remember in the February of 2022, just 4 months ago, when we did our annual summit, many thought leaders from the industry, they came and they kind of they maintain that IT as a sector should continue to do well. So if I ask them this question, what are the top three sectors? Two out of those top three sectors, which were common to all thought leaders, were financial services and IT. But suddenly now your view on financial services is different, and at the same time, IT stocks have fallen. I'm not wanting you to answer about financial services here in this question, but about IT. What is the view on IT? What has suddenly happened? Why stocks like TCS, when they have announced even a buyback at 4,500 around 3 months ago, stocks like Infosys, when they were kind of filled with orders, and employees working there are actually getting high bonuses. So what is really happening? Why market is not giving thumbs up to IT at the moment?
Sure. So first, see, end of the day, valuation is always a narrative, right? Market works through the combination of two factors. One is the numbers stacking up, which is what you spoke about, where the numbers are beautifully stacking up for the IT sector at large. And second is the narrative, which changes from time to time. So the narrative back in 2020 was we were moving into a COVID-driven world where digitization becomes the so-called norm for every business. And that narrative has not changed, right? Now, in India, right, you have large cap IT, mid and small cap IT. Now, someone like an Infosys and a TCS consistently is showing almost a 3 to 3.2% QOQ growth on a conservative basis. You analyze it, it's almost 16 to 17%. Some of these mid and small cap IT companies are also showing maybe 4 to 4.2% QOQ growth. So a large cap is showing a annualized growth of 16 to 17%. A mid cap or a small cap maybe at best is giving you a 20 to 22% QOQ growth. Sorry, annualized growth, right? And look at where the market valued these two. Large cap was valued at a multiple of 22 to 23 1 year forward. Mid and small cap IT was valued at almost 70 to 90 times from a multiple perspective in many cases. So you are seeing some amount of normalization there. Now, why are we seeing this narrative change in the short term? For the first time, people are acknowledging that US is under a risk of recession. Now, in a recession, if you are running a company in the US, let's say you're running a Fortune 500 company in the US, right? There are two things that you would do. First thing is you would cut people. Second thing is you would cut IT spends. Many of these US companies have been running on at least 5 to 7 SaaS-based softwares over the last 3 years. It was a bull market. Everything was good. You don't talk about IT spends rationalization. It's during periods of difficulties that the first thing that you go to is employee cuts, because that's your operational leverage. Second thing that you do is, do I really need an IT spend? So the narrative has slowly changed. So while the order book that you saw, let's say Infosys saw $2 billion contracts for the first time in its history signed up, right? So they need to be very thankful for it, because in the June quarter, I don't expect them to be signing the next $1 billion contract, right? Because companies are going to pull back. And that narrative has what has changed. And you are getting a small correction here. See, when I say small, I think 20 to 25% correction in an Infosys and a TCS is par for the course. Whereas what you revalued in the form of a structural 10-year story with small caps, there they are correcting a lot more significantly. So again, the narrative has changed in the short term. Market is basically punishing those where valuations were not paid attention to. And today now people are questioning, is IT structural or not? I think end of the day, my view continues to be IT deserves a place in your portfolio. Now you need to figure out where you want to go into. You want to go into large cap IT, or you want to go to mid and small cap IT where you have much higher drawdowns, but which are those companies that can still structurally grow? That's the call that one needs to make.
And with the fear of US getting into recession, what are the other sectors then that you think should benefit out of it?
So, end of the day, see, where this recession, if it does happen, right? I mean, technically, a recession is, you can think of it as a GDP contraction over 3 quarters, right? That's the simplest way to define recession, right? Because while we use these terminologies, just as we use growth and value liberally, we also use the word recession liberally. What is recession, right? When your GDP on a quarterly basis contracts over 3 quarters, you can say that structurally the economy could be under recession. And we are in the first stage of that. Let's see in the next 2 quarters. There is a risk that we could get because liquidity is getting sucked out of the system. Now, obviously, because of that, the pain is going to get filled by employees getting cut first. So, in the last 3 years, you would saw a lot of people filing for unemployment in the US. Why? Because the Fed was doling out $1,200 per month when you file for unemployment. A lot of these people were reinvesting that in the Robinhood and the Bitcoins of the world. And they were extrapolating their returns in an IRR for the next 10 years and saying, I'm set. Now, all that party is finished. So all of this needs to get rationalized and people need to come back into the labor force. And I feel that could be a 6 to 9 month phenomenon. Over the next 2 to 3 quarters, you will see supply demand rationalization. You're also seeing, so actual value in the US is 3 places, right? There is energy, there is metals and mining, and there is natural gas, right? Lot of this is doing really well. Unfortunately, in India, these are not sectors you can play structurally. What do I mean by that? When Warren Buffett buys Occidental Petroleum, he is actually buying a private company which is capitalistic in nature, whose PAT is going to grow up significantly because of where oil prices are. The equivalent of that in India is for us to buy ONGC. The government can easily go and cap prices, just as you saw around what they import. They put an import duty on steel. They can do that for sugar and ethanol. They can, any monopolistic sector where you have government intervention in India, you will always look at it as value. But if you are not functioning in a capitalistic market, there's no point of that value being there. So that's where most of what you see in the US, you superimpose it to India, it really doesn't work. So value is in India is effectively, it has to be a combination of growth when you buy it at a reasonable price. That is what value to us means in India. So I think what could benefit in the short term are these businesses that are still showing growth, right? You have good specialty chemicals businesses that are showing margin expansion even during this quarter. You have B2B manufacturing businesses setting up capex. You have cable and wire businesses which are setting up capex with structural growth behind them. So there are pockets, and you still have IT. I still think so. I didn't answer that question, Kamal. The Nifty Value Top 50, Nifty 50 Top Value Top 20 Index has 42% exposure to IT today, right? So there you go. You have value in IT. If you think that is value, you should be buying IT. And I asked you to guess the weight of financial services. Can you make a guess?
50.
The answer is 0. It's there for everyone to see. I'm not making these numbers up. This is basically NSE publishing this index, and you have Nippon and you have 2 other AMCs giving you passive opportunities on this. So people need to understand what value is, what growth is, and then take a call how to position themselves. So if you're talking about IT, yes, there is value here for sure.